Today, the 50-year mortgage coming soon. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, those of you following my Monday rants with Edwin will know that we've been discussing some of the levers that we suspect will be used to try and prop up the property market. We're not advocating it, but we're thinking that that's perhaps what they're going to do. And as well as increasing migration and throwing more incentives at first-time buyers and twiddling with stamp duty, one of the things that we've been talking about is the 50-year mortgage. After all, a few years ago, the average mortgage was 20, then 25, and now 30 years. And guess what? The 50-year mortgage is now likely to be a thing, at least in the UK, because Downing Street is exploring the idea of trying to tackle the housing crisis with ultra-long mortgages of up to 50 years that could pass between generations, allowing more people to build up equity rather than paying rent. Mortgage experts say the idea could bring some benefits but flag problems, including the potential of saddling children with debt and the fact that it would not tackle the fundamental issue of housing supply. Under the plan being examined by number 10, a longer mortgage period would allow people to borrow larger sums with the possibility of passing the debt on, although it remains unclear what government action would make this happen. Other housing ideas being considered by Downing Street include trying to free up government-owned land for rapid home building and exploring whether institutions such as schools could buy homes for key workers priced out of local areas. Boris Johnson, speaking to reporters during his trip to the NATO summit in Madrid this week, confirmed that the idea of a 50-year mortgage was being looked at, saying the government wants to find all sorts of creative ways to help people into home ownership. He said last year, we had 400,000 first-time buyers. That's a great number. We're starting to turn the tide, but it's crucial for this government and for our overall economic story if these numbers continue to be strong. We need young people to have the confidence to have deposits, the mortgage packages to be able to get into ownership. If you're good enough to pay a lot in rent, we should find ways to help you to convert that into a mortgage. And asked if he was considering ultra-long mortgages, he replied, yes, certainly. The idea of multi-decade mortgages being transferred between generations is actually not new, and it's been pioneered in Japan, where 100-year family mortgages have been offered for some time. In the UK, relatively long mortgages are already the most common. According to the Building Societies Association, 37% of first-time buyers took out mortgages of between 30 and 35 years, with only 10% opting for less than 20 years. The key challenge is the decades-long acceleration of home prices beyond growth in pay. In England, people in full-time work now need to spend an average of 9.1 times their annual earnings to buy a home. And longer-term mortgages would mean people could borrow greater sums with the same monthly mortgage repayment, potentially opening up many more homes to those currently unable to buy, who might end up spending less money on repayments than they do currently on rent. What these mortgages would not do, however, is solve the long-term shortfall in house building. Graham Taylor, the managing director of mortgage firm Hudson Rose, said the idea had complexities. On the face of it, it seems like a great idea, he said, but the problem remains that the loan would need to be affordable for all the original applicants and also the children who inherit it. Otherwise, the children could risk inheriting a liability they are unable to manage, which, when secured against your home, has catastrophic consequences. Other potential complications include that when a property is passed on to children, inheritance tax could be liable, and the prospect of people having to maintain payments into retirement. Rob Gill, the managing director of Ultra Mortgage Finance, said that if the plan did open up the market to more first-time buyers, this would have the effect of keeping property prices artificially high. It seems governments the world over will do anything to avoid the alternative of property prices actually falling, he said. Well, that's a pretty good summary, and I have to agree with those arguments. But there's something else I want to highlight, and that is that this scheme ultimately benefits the banks less than individuals. And to show you that, I want to share with you some modelling that I've done. So what I'm going to do is to look at a mortgage for $455,000, a principal interest mortgage at 4.5%. And we're going to look at the monthly repayments at different loan terms and also the total interest that's paid over the life of the mortgage. So on a 20-year mortgage term, the average monthly repayment, based on that parameter set, is $2,879 a month. And the total interest that is paid over the life of the mortgage would be $235,854. This is based on information I'm using from the CBA mortgage calculator. If you go to 25 years, then the monthly repayment drops to $2,530 for the same mortgage, just a longer term, but the amount of interest that you pay goes up to $303,712. If you go for a 30-year mortgage, then the repayment drops to $2,306 a month, but the overall interest that you pay through the life of the mortgage is $374,951. If you go to 35 years, it's $2,154 a month, but you end up paying $449,394 over the life of the loan. If you go to 40 years, it's $2,046 a month, but you end up paying $506,846 over the life of the loan. At 45 years, it's $1,967 a month. You end up paying $607,098 over the life of the loan. And at 50 years, you end up paying $1,909 a month, but you end up also paying $689,935 over the life of the loan. So you can immediately see that the benefit in terms of the reduction in the monthly repayments is more than offset by the massive increase in the bill for interest that you pay over the life of the loan. Like I say, the bank will love you, but the question is, are you prepared to pay a lot more? And just to bring that home, here's another way of looking at the same information. So I'm looking now at percentage changes. So I start at 20% and 0 percentage change. At 25 years, repayment drops by 12%, but the amount of interest that you pay goes up by 29%. At 30 years, you get another 9% drop in the monthly repayments, but the overall interest bill goes up by 23%. If you go to 35 years, you get a further 7% reduction in the monthly repayments, but the interest bill goes up by another 20%. At 40%, it's 5% in terms of monthly repayments. It's still a 70% increase in the total interest paid. At 45%, you get a 4% benefit in a reduction of monthly repayments, but you're still paying 15% more in terms of interest. And finally, at 50 years, you get a further 3% benefit in terms of cheaper monthly repayments, but the total interest still goes up by 14%. So the point I want to make here is that this idea of a longer term mortgage, whilst it might be packaged up and sold as yet another way to help first-time buyers, the truth is this ultimately simply helps the banks to make more profit for longer. And also it really converts a mortgage holder into a rent payer, because most people probably will die before they pay off the mortgage. This is a scheme that must be resisted. It is not a route to dealing with housing affordability. In fact, it's yet another scheme to avoid dealing with housing affordability issues. And as I've said on a number of occasions, if you really want to deal with housing affordability, we need to, 1, let properties come back to a more realistic level relative to income, 2, tighten lending standards, and 3, invest massively in social housing. Those are the levers to pull. The levers around extending mortgage repayments over a longer period, or indeed just throwing more incentives at first-time buyers, do nothing to solve the problem. In fact, what they will do is lift prices even higher. But politicians, of course, want the short-term fix and want the kudos. Nobody wants to tackle the structural issues that we have here that have been built up over at least 2 generations now. I wish somebody would step up and take responsibility for this, because otherwise this is going to become a bigger and bigger drag on the economy into the future. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.